Hi. Let's learn about inherent risk. Inherent risk is a form of raw risk, any that occurs naturally due to a factor other than a failure of internal control. In a financial audit, inherent risk is most likely to occur when transactions are complex or in situations that require a high degree of judgment in regard to financial estimates. This type of risk represents a worst-case scenario because all internal controls in place have nonetheless failed. Examples of inherent risks include disruptions in supply chains, unaudited financial statements, or even unedited social media posts for businesses. The simple definition of risk is the potential for a bad outcome. In the world of finance, risk refers to the chance that a venture's end result will be negative or in a loss. Some of the types of risk include operational risk, market risk, liquidity risk, and inherent risk. Inherent risk is the natural risk that occurs without any risk management controls. When conducting an audit or analyzing a business, the auditor or analyst tries to gain an understanding of the nature of the business while examining control risks and inherent risks. If inherent and control risks are considered to be high, an auditor can set the detection risk to an acceptably low level to keep the overall audit risk at a reasonable level. To lower detection risk, an auditor will take steps to improve audit procedures through targeted audit selections or increased sample sizes. Complex financial transactions, such as those during the lead-up to the financial crisis, can be difficult for even the most intelligent financial professionals to understand. Asset-backed securities, such as collateralized debt obligations, became difficult to account for as tranches of varying qualities were repackaged again and again. This complexity may make it difficult for an auditor to make the correct opinion, which in turn can lead investors to consider a company to be more financially stable than in actuality. Inherent risk is one of the risks auditors and analysts must look for when reviewing financial statements. But there are other audit risks that auditors must look out for on a regular basis. We've highlighted some of them below. Inherent risk is often present when a company releases forward-looking financial statements, either to internal investors or the public as a whole. Forward-looking financials by nature rely on management's estimates and value judgments, which pose an inherent risk. The same applies to accounts that require approximations or value judgments by management. Fair value accounting estimates are tricky to make and can be highly subjective. Here are 4 key takeaways. 1. Inherent risk is common in the financial services sector due to complex regulations and the use of difficult-to-assess financial instruments. 2. In a financial audit, inherent risk is most likely to occur when transactions are complex, or in situations that require a high degree of judgment in regard to financial estimates. 3. Inherent risk is the risk posed by an error or omission in a financial statement due to a factor other than a failure of internal control. 4. Inherent risk is one of the risks auditors and analysts must look for when reviewing financial statements, along with control risk and detection risk. Hope this would help. Thanks for watching.